Hello everyone, it's Professor Reiko here. We're continuing on with our chapter on cash and receivables. So our last 2 to 3 remaining videos will be on notes receivable. So we've talked about accounts receivable, we've talked about sales discounts, sales returns, things like that. So our last few videos wrapping up the chapter will be on our notes receivable. So if you see up here at the top, it says they're more formal than accounts receivable, and that basically they're supported by a promissory note, which is a written promise to pay. So it's actually signed. And then we also have interest is generally charged. Notice that says generally charged for notes receivable. So some key terms here before we get into the accounting for it. We have creditor and debtor. So the creditor is the person to whom the money is owed. Debtor is the person who owes the money. All right, so in this chapter, we have the receivable. So we are the creditor. Okay, interest is just the cost of borrowing money. So remember, principal times rate times time is how we calculate interest. Maturity date is the due date of the note. Principal is the amount owed. All right, so it's also called the face value. And the term is the length of time to pay the money. All right, so if we have a note issued at face value, okay, this happens when the stated rate on the note, okay, equals the market rate of interest for a note. All right, we'll also have notes that are non-interest bearing. We'll get to that in a little bit. All right, so as such, there will be no discount or premium, all right, on the note. And so our journal entries are going to be pretty straightforward. All right, so I like to start with this, and then the examples I'm going to do will have the discounts or premiums included, and then we'll do a non-interest bearing note as well. All right, so this is kind of our baseline here, but sometimes on a real 2 to 3 month short term note, you might have something that looks just like this because it's such a short period of time that it's just pretty straightforward. All right, so when we record our first journal entry, we have notes receivable. All right, so remember, this is going to be the principal amount, PRIN, yeah. So the principal amount, and then you could have any number of credits here. I mean, if we loan somebody money, we'd be giving them cash. All right, so that'd be a loan. If it was for a sale, meaning let's say we sold something and they needed a longer period of time to pay it off, they might sign a note for it. Or accounts receivable, this would be a switch from accounts receivable to notes receivable. So if you think about that, let's say we originally had a sale or we had accounts receivable sales revenue, all right? And meaning somebody bought something on account. And then, after a couple weeks, they come to us and they say, hey, we're short on cash. We need longer to pay. Can we have 6 months to pay? We'll sign a note and pay interest. If that was the case, we would take this accounts receivable off the books with this credit right here and replace it with a note. Okay, so that's just another possibility. All right, I'm less concerned with what the credit is in that journal entry because we're really not focusing on that. We're focusing on the note. All right, so each period, we're going to recognize interest revenue. Okay, now there's a couple of different ways to do this. Sometimes interest is paid each period, each month, and sometimes it's accrued. Okay, so that could be interest receivable. Sometimes, and it's a real short-term note, all the interest will be paid at the end. Okay, so depending on what's going on in the note, you'll be cash if they're paying interest every month or every period, or if they are accruing it, it'll just be interest receivable, and that receivable will build up until the end, and then we would take it off the books when we paid all the interest back. All right, this interest revenue, this goes to our income statement. It'd be in that other revenue and gain sections, all right, of your income statement. Okay, and then so when we collect, so we would do this entry right here essentially every month as we were going through the life of the note, assuming it's a short-term note. We are still kind of in our current asset chapter, but you could have long-term notes as well. All right, and then at the end of the life of the note, we are going to receive the cash. All right, so this is going to be either the principal or the principal and interest if they haven't been paying the interest as we go. They're going to pay off the notes receivable balance. Okay, so this will be now zero because they're paying it off. And then we'll have the interest revenue, and this will just be the current period's interest. All right, so I'm going to put current period, meaning up here we recognize an interest revenue every month, and then the last month, assuming it's at the end of the month, would have to recognize that month's revenue as well. All right, so if we notice here, it says typically notes will not be issued at face value, so there will either be a discount or a premium depending on the stated rate on the note and the market rate at the time. All right, so that's what we'll get into next. And then you might have non-interest bearing notes where there's not a stated rate explicitly stated on the note. So we'll talk about that. All right. So notes receivable are valid on the balance sheet at their net realizable value, which is similar to accounts receivable. So they would adjust it up or down. Most books don't get into that as much. Okay, so I'm not either. All right. So this video here just gives us an overview of notes receivable, kind of a baseline, how to account for them when there's no discount or premium. But now the examples I'm going to do is going to incorporate the discounts in and then kind of compare interest-bearing notes to non-interest-bearing notes. So that will be the next two videos, just working through examples on that. So once again, this is another example. I said this earlier, when you have two different types of ways to account for something, like if it's interest-bearing versus non-interest-bearing, that changes the accounting for it. That's really something that's real, it's very important to keep that straight come test time, because chances are if you have a problem that you're only going to have one problem, not an example of both of them. And so you want to make sure you know exactly what you're talking about and you do the right journal entries for the problem that you're given on a test. All right, so next couple of videos will be examples, and then we'll wrap up this chapter after those videos. So hopefully this helps a little bit, kind of get us into notes receivable, and then the next two videos, hopefully they help you really kind of get into the details of it. All right, so tune in next time as we go through the examples, and I'll see you then.